So this is Chapter 11, Part 3 of the lecture. So those were the entries, just assuming the bonds were issued at a discount, including the bonds then being redeemed early at 103, and the entry that was made to reflect that. So again, debit to bonds payable for the face amount of $1 million. Credit to cash for 103% of the face amount. That was the price that they would be redeemed at. The discount account having a debit balance of $16,000, we'd have to credit that account for $16,000 to make it go away. And then what's left over is we would need a debit of $46,000 to get the entry to balance. And of course that would then be the loss on the early redemption of the bonds. And typically that would be the case. There would be a loss as a result of that. And the reason, though, that companies may still do that and recognize the loss, if interest rates, for instance, have declined significantly, then they could refinance at a much lower rate. In this instance, they may have felt that over a number of years that the borrowing would be outstanding or the bonds would be outstanding, that they could save well more than $46,000. So it would be worth it to take that loss because they could save well in excess of that in interest payments over time. So it may make sense. Now, if the contract rate is greater than the market rate, then our bonds would sell at a premium. And so that's we'd have the same really group of entries. And let's say the bonds were issued at 102 instead of 98, so they're issued at a 2% premium versus a 2% discount. Our entry would just be simply to debit cash for the $1,020,000. Again, credit bonds payable, which is always the face amount, for $1 million. And then you'll notice that instead of a debit that we had for the discount, we have a credit for the premium of $20,000. So we would make that entry into an account called premium on bonds payable, which again would be handled the same way. It'd be a contra liability account, but in this case it would add to the bonds payable instead of subtracting from the face amount of bonds payable. And then when we make the interest entries, it would just be debit to interest expense, credit cash, and again cash would be the same $30,000 each period. Here what we're going to do is take 1/10 of the amount, just like we did before, but here you can see that it's going to be a debit to the premium account for $2,000, and therefore our interest expense instead of 32 is going to be 28. And again, the reason for this is because the market rate of interest was actually less than our contract rate, and therefore our interest expense is less than our contract rate, which is our cash amount. So that all makes sense. So again, same set of entries for premium as they are for discount, except they're just kind of really in reverse. So crediting the premium account instead of debiting the discount account. And then when we amortize, we're just debiting the premium account over time. So hopefully that takes into account all of the basic transactions for the issuance of bonds, the payment of interest, the amortization of any premium or discount, and then the early redemption of bonds payable. So the next thing we're going to talk about, or the last thing we're going to talk about in this chapter, is how do we calculate that bond price? So we know that a bond may sell at a discount or at a premium, but how actually do we calculate that bond price? How do we actually arrive at that amount? And the way that we do it is actually by determining the present value of the cash flows that would equate to the market rate of interest, not the contract rate, but the market rate of interest. Okay, so it's all driven off the market rate. But let's first of all kind of just address the idea of this present value. Present value is really nothing more than this idea of the time value of money. And time value of money is not necessarily purchasing power, not necessarily inflation related, although that can be a part of it. But what we're really talking about here is that if you had $100 today and you could earn a return of 10% in the marketplace, then $100 today would be worth more than $100 in the future. Because what you could do is you could take that $100 and let's say this future value, let's say this is in 1 year. 1 year from now, you could invest that $100 and you could make 10%. So a year from now, $100 is the same as $110 a year from now. So if given the choice, you could receive $100 today or $110 a year from now. And if you wanted to earn 10% on your investment, then you'd be indifferent between the two. You'd take $100 today or you'd take $110 in a year from now, because either way, you would get the same amount of money. As you could easily take the 100 today, invest it, and earn 10%, and then you'd have 110 in a year from now. So that's the easy way to think of future value is, gee, how much is that going to grow to some future date? And that's the way we tend to think about investments. What we're going to do, though, is kind of flip this around a little bit and look at it a little bit differently. And we're going to say that there was an investment that would give you $110 in 1 year. And then the question that we're going to ask ourselves, and I'm going to pause this and write the question down. So the question we're going to ask is, if I were going to receive $110 in 1 year, the question is, how much would I pay to receive $110 in 1 year if I want to earn 10%? So in other words, if somebody came to me with an investment and said, hey, you can earn you can receive $110 in 1 year. If I knew that I needed to make 10% return, I wanted to make a 10% return, that was the market rate of interest, then I would be willing to pay how much? I'd be willing to pay, of course, looking at the equation up above, I would be willing to pay $100 for that investment. Because if I paid $100 for that investment, I would make, and I received $110 in a year from now, I would have made exactly 10%. So that's how we're going to think about it. What do I need to pay today if I were to receive a certain amount in the future and I wanted to achieve a certain market rate of return? And the 10% represents the market rate of return. So that's our market rate. The amount we're going to invest today represents how much are we going to pay for the bond. That's the bond price or the bond proceeds. How much are we going to pay? And the 110 represents the combination of the interest payments at the contract rate plus the face amount at maturity. So that's what I'm going to get in the future, and I know my market rate. How much am I going to pay today for that series of payments? How much am I going to pay today if I want to earn the market rate of interest? So let's see how that works. So the first step So the first step is to identify the first step is to set forth our examples. So let's just take an example here. We're going to issue $1 million, 5-year, 11% bonds when the market rate of interest is 9%. Okay, so let's just look at it from the investor's point of view. I think that's the easier way to think about it. So from an investor's point of view, I'm going to get a series of interest payments, and I'm going to get the face amount repaid back to me. And I'm going to want to know how much I'm going to pay to receive those payments and earn 9% on my investment. Okay, so first of all, the first step would be to calculate the amount of interest we're going to receive. And that would be $1 million times 11% times 1/2. And so basically, we're going to get $55,000. And that's going to continue on twice a year for 5 years. So that's going to be 10 payments, 10 periods. The face amount, and so that's going to go through year 10. So we're going to get 10 of those payments. And again, that's $55,000. That's at the contract rate. That's never going to change. We're also going to get repaid $1 million at the end of the 10 years. And so the question now becomes, how much am I going to pay if I'm going to receive 10 payments of $55,000, and I'm going to also receive $1 million at the end of 10 years, and I want to earn a rate of 9%. How much am I going to pay for that today? Now, the way I'm going to do that is I'm going to calculate the present value. Just like I calculated the present value above, going from 110 to 100, I can use present value factors to bring those payments back to the present value. And the way I can do that is, even up above, the present value factor of 10% for 1 year would have been 0.909. If I would have multiplied that by 110, that would have given me the present value amount of 100. So I'm going to do the same thing here. So for the face amount of $1 million, I'm going to go into the present value of $1 factor, and I'm going to get a factor. It's going to be 0.64393, and this is in the appendix. It's in your book. And if I were to multiply that out, the amount that I would pay today to receive $1 million 10 periods from now and earn 9% would be $643,930. Now, the way I'm getting that factor is I'm basically, because I have 2 payments each year, instead of 5 years, I have 10 periods. And because I have twice the number of periods, I have half the interest rate. So I have 4.5% rate of interest. So a 4.5% rate of interest for 10 periods. That's how I'm going to get this present value factor. I also am going to look at the fact that I'm going to get a stream of payments over 10 periods. Instead of multiplying each one of those by the present value factor, I can use what's called an annuity factor. And I can just take 1 year and multiply it by the annuity factor for 10 periods at 4.5%. That would be 7.91272. And if I multiply that out, I get the present value. These are the present value numbers. So I'd get the present value of that to be $435,200. So if I add the present value of the interest payments together with the present value of the face amount, I get $1,079,130. So those bonds are going to sell at a slight premium because the market rate of interest is lower than the contract rate.